Now, moving into our main topic, Herwig, you are the CEO of Security Token Advisors and have worked with hundreds of clients regarding this industry. And you're constantly working with issuers and discussing with them their liquidity strategy. And so one of the things that you previously mentioned during episode 34 on exchanges and marketplaces was a private issuer managed market. So today I'd like to dive into that a little bit more. Could you explain how that works in reality?
Absolutely, Kyle. I also want to say congratulations to the work you're doing over at Security Token Market. Very exciting to see it, an international market of equities now available, and it's only going to grow and cover even more jurisdictions. Very, very cool to see that now live on Security Token Market. But anyway, I'm happy to answer your question because that was a great episode talking about the different ways you could, develop a liquidity strategy, if you will. It's one of those main elements of any security token application, and oftentimes the issuer doesn't realize that the technology already exists to enable their own liquidity without needing a broker or a third-party exchange platform or the like. So to key to understanding, though, how all this works is understanding how investor whitelists work. Now, investor whitelists are not a new phenomenon. Companies are already familiar with the term blacklists when it comes to onboarding investors, right? At the end of the day, KYC and AML and other compliance solutions were born out of the need to scan potential investors who might fall into a blacklist, which is determined typically by a series of rules and regulations. A whitelist, on the other hand, if you're not familiar with the term, is exactly what it sounds like. Instead of a list of banned investors, like with the blacklist, you get a whitelist, which is an explicit group of investors allowed to invest and transact. So if you aren't on the blacklist, aren't you by default on the whitelist? And the simple answer is yes. But most, at the end of the day, most companies, whether they're public or private, don't usually need to use a whitelist. In the public markets, you have broker-dealers, compliance companies, transfer agents, you even have exchanges. They've all developed an infrastructure to let investors access the company on the public exchange and then invest. One could say you're on a whitelist, if you will, if you have a brokerage account with access to that company. But for private companies, this process is typically very different due to the fact that both secondary sales are managed typically by the company themselves, and they're usually far less frequent compared to the public counterpart. So the reason why whitelists are not necessarily so prevalent is because private companies typically didn't have liquidity or market for their stock, usually with their investors having an expectation to hold the asset for a long time. We're talking multiple years, maybe 5 or longer, or that the expectation is to simply harvest their position in annual profits and dividends and to never sell except for maybe if it's back to the company or to another investor. But now, with the advent of digital securities and the internet and blockchain, private companies are able to create that digital access for investors to buy their stock, all without the hassle and cost. Because, of course, traditionally, the company would deal with an investor offline directly, and a series of papers would go back and forth, typically through lawyers, to ensure eligibility in a legal sale. This is a process that was too hard to streamline and too complicated and cumbersome for most investors and the issuer, especially not on a scalable fashion. So now, thanks to, of course, this beautiful technology, an issuer-managed market is possible. As we discussed in episode 34, in the Exchanges 101, a private company can now go to a third party to help create liquidity for them, such as an exchange or a broker-dealer with an ATS. And the only alternative to that, of course, is to manage their own market themselves as the issuer, or, of course, to go public. So due to the fact that security token infrastructure is still coming about, i.e. there are not a lot of marketplace and exchange options available yet, many security token projects as a result have gone to manage the market themselves in order to create liquidity. And think about that for a second. In the end, that's all that the public markets or third-party solutions for private companies are doing, is they are managing an investor whitelist and the technology to power trades between them for specific assets. So you take a platform like Open Finance or T0, they've set up the infrastructure, they have the right licenses, and they've enabled a specific user base, aka a whitelist of investors, to trade the assets on their platform. But since they are a third party, they of course have a lot more scrutiny and regulations and rules they have to follow, being licensed and with FINRA or whichever jurisdiction that they're in. And as an issuer managing your own whitelist, you have a lot more freedom and flexibility because you are the issuer themselves. So since the technology drives most of the functionality already to make a trade, all you need to do is implement the right tech stack and the right processes to power your own private market for your issued securities. We'll walk through it in two different examples. Kyle, ready? The first example is the realty example. As we've just been talking about many times on the show, realty tokenizes individual U.S. residential properties. You can purchase a stake in their upcoming projects via a security token directly from their site, realty.co. But in doing so, Realty will also check your KYC and AML and your eligibility, especially depending on where you reside from. After that additional governance, Realty has all the information needed to onboard you as an investor, and now Realty has added you to their whitelist of investors able to purchase from Realty. Now, it's important to recognize that Realty, as the issuer, is doing the compliance and providing the software to onboard an investor and then enabling them to purchase Realty's issued securities, in this case through an online dashboard. So you can, of course, as an issuer, build that technology yourself or leverage third-party solutions to cobble that together, or an all-in-one solution like an issuance platform, which Realty also does. Now, Realty enables you to purchase directly from them through their site, just like a crowdfunding portal, and you'll be issued a security token, of course, after whitelisting. But it's important to recognize the whitelist's other role, which is anyone that has been whitelisted is now eligible to purchase from other owners of the securities. They are co-investors. So now if Kyle and I were both whitelisted by Realty, we can purchase tokens from each other. The only thing missing, of course, is a compliant and technical way for Kyle and I to make that happen, to make that trade occur. And in this case, Realty partnered up with a decentralized exchange called Uniswap to enable whitelisted users to trade peer-to-peer with each other on Uniswap, the security tokens that represent the ownership in real estate. So it's very powerful. It's, of course, important to note here that Uniswap is not a broker or a third party acting on behalf of the transaction. They are simply providing the technology platform to enable compliant peer-to-peer transactions digitally between a whitelist of investors that, in this case, Realty manages. So let's use a different issuer, but the same platform as well. So as you mentioned, we now have the MPS token by Mount Pelerin. And as a Swiss-based issuance platform, they have different regulations and different rules to follow. And as you might have caught, has a restriction on different countries, including the United States. Additionally, the token it's worth mentioning is tradable on another platform, Fork Delta, as well. So you can actually trade on two different decentralized platforms. But of course, you must register the MPS tokens with Mount Pelerin on their site, aka where they add you to the whitelist. Now, because you investors are not able to purchase the MPS tokens, Kyle and I couldn't access them on Uniswap, even though we can buy the Realty tokens. We would need to be added to Mount Pelerin's whitelist, which of course wouldn't be possible since we reside in the US. This is an important distinction because Mount Pelerin needs to be able to make sure its securities are trading compliantly, which in this case meant restricting access to them for US investors. Now, if we compare the entire experience we just talked about, of course, compared to its traditional counterpart, this is far more efficient because it's completely digital. If we had to try and allow a free secondary market of stock on a manual, offline, paper basis, it would be extremely cumbersome, expensive, timely, and costly as a result. Now, as an issuer, we can leverage trading software companies such as Alpha Point or others that offer the tools and technology needed to power and create a secondary market and, of course, manage a whitelist. And additionally, smart contracts enable all sorts of capabilities to create structured buyback programs. They could potentially route every single transaction through the issuer's treasury, and even a lot more different use cases will arise, as the industry grows. Even the whitelist investors, whitelists managed by OFN, T0, and other marketplaces will grow themselves, and private companies can eventually leverage those whitelists as well. Or maybe even do a combination of managing their own and using one of these third-party marketplaces. So ultimately, whitelists govern who can invest, and security token technology enables issuers to onboard investors and manage a peer-to-peer environment for trading around the world for their securities.
What a great rundown, Herwig. Whitelists have become an incredibly efficient way, as we've seen as of late, for issuers to manage the liquidity for their issued securities, especially because we've seen a lot of these early marketplaces, ATSs, and exchanges kind of struggling to get off the ground. And so by managing the whitelist themselves, they can directly control which countries can participate based on the advice of their legal teams, based off the funding regulations that they're using. Uniswap itself has been an incredibly effective medium for powering this liquidity. And when we now judge by the total number of listed securities, it's actually the largest security token exchange in the world. So it's really cool to see that decentralized model allowing issuers to plug in and manage their own whitelists, which drastically reduces the costs as opposed to ATSs or exchanges that have to deal with legal fees and all of those other things that have really been a hindrance for many of these newcomers and incumbents into the space. So hopefully other options like Alpha Point will also be able to provide great solutions for asset issuers around the world. But it does make me wonder, how do you see the issuer-managed private market solution fitting into an issuer's overall liquidity strategy?
That's a great question, Kyle. Ultimately, you'd have to pay us a retainer at STA to really dive into that, but I'm just kidding. I'm happy to answer that. Ultimately, I think it's going to become a default part of the suite for any issuer, and ultimately, I think it's going to be incorporated into tokenization or issuance platforms, if you will. From one perspective, you already have the end-to-end solution like T0, which will tokenize and then list on their marketplace as well. They, of course, have the benefit that they're also licensed to provide liquidity and can aggregate a larger whitelist of investors over time. As a private issuer managed market, you are building your own whitelist, which, of course, for many can take a long time. So instead, I expect a lot more of these use cases for this model to apply perhaps to institutional products or for issuers who want to specifically limit the pool of investors to specific individuals or a type of individual. And finally, of course, you might look at large-scale investment programs offered by private companies that want to grow over time as a great solution to manage their own markets. And, of course, all of this saving them on costs as well and offering some level of liquidity without necessarily having to go all the way. So I think that it will definitely find its place as a solution, and I think we're going to see many issuer managed private markets come about.
Absolutely, I totally agree with that. I think that certainly it depends on an issuer-to-issuer basis. It depends on the specific asset and the demand and many other factors that really depend on the case, which is why I think it is important that if you're an issuer considering these strategies, to definitely reach out to Herwig to find ways to work together, because this expertise will be important to be custom fit based off of the different engagements. But it does seem like an interesting intermediary step for me, where issuers can provide some of that liquidity for their early investors, or to at least be able to establish that market early before having to scale to more of a formal option or established option, if you will, institutional option, whatever you want to call it. Certainly the peer-to-peer marketplace, at least at this time, doesn't quite seem as scalable as some of the more high-volume options. But at the same time, as we've mentioned, the costs are low, and it certainly is available now and can be leveraged now for issuers, which is a tremendous advantage, certainly in the current space.
Another great episode, Kyle. That's all we have today for those of you listening, and we hope to catch you again next week.
Security Token Show, episode 37. Thanks for listening.